Good morning, everyone. I'm Olivia, and I'd like to thank you for attending today's webcast. Today we'll be presenting Let's Talk Tax, State Income and Sales Tax Updates. Before we begin, I'd like to review a few housekeeping items. First, we encourage you to ask questions. To do so, please send them to us using the Q&A box on the lower left-hand side of your screen. We will try to answer all of your questions during the webcast. If a fuller answer is needed, or if we run out of time, your question will be answered later via email. Second, to earn the available 1 CPE credit during today's webcast, you must listen to at least 50 minutes of the presentation and answer at least 3 polling questions. Please note that you must be logged in individually to receive credit for today's webcast. If you are attending as a group, only the individual who is logged in will receive credit. If you've completed the requirements, your certificate will be available for download at the end of the webinar. I'll walk you through how to download your certificate after the presentation has concluded, so please stay on the line. Lastly, you can download a copy of today's presentation from the green Resource List button at the bottom of your screen. Here, you will also find our webcast frequently asked questions, a document which offers some basic troubleshooting information and other useful tips. Again, this can be found under the green Resource List button at the bottom of your screen. Now, thank you once again for joining. I'll hand it over to Yvonne.
Thank you, Olivia, and welcome, everyone. I am very excited to moderate this session, Mazars Tax Talk, featuring state and local tax. I hope this is going to be an interactive and fun panel discussion. We target to give a quick refresher to everyone about some of the hot existing state issues, and we want to share some recent updates to state income and sales tax. More importantly, we also want to share with you the Mazars approach to state and local tax as a group. So I want to introduce the amazing panelists that we are having for today. We have Harold Hatch, Managing Director, and our U.S. State and Local Tax Group leader. He has a focused insight to a diverse group of multi-state public companies, financial service organizations, closely held corporations, partnerships, and individuals. His specialty extends to all areas of state and local taxation, including tax planning, tax minimization, FAS 109, FIN 48, and tax controversy. Welcome, Harold. We also have Julie Montron with us today. She is a senior manager with nearly 15 years of experience, providing multi-state tax services to clients ranging from mid-market to large multinational companies. Her expertise includes state tax planning, tax provision, and state tax compliance and consulting services for corporations and pass-through entities. And we also have Harold Johnson here with us today. He is a senior manager in our state and local tax group. Harry advises on a variety of state and local tax issues, including planning, tax minimization, restructuring transactions, return review, and tax controversy. Last but not least, Kevin Melson, our state and local tax manager. He joined the state and local tax group at Mazars in 2021. Primarily working on state nexus studies, taxability analysis, and sales and use tax compliance. Prior to joining us, he was a tax auditor for the state of Arkansas. So greetings to you all from both West Coast and East Coast. I think the fact that all 5 of us are getting together for this live panel discussion already demonstrated the importance of today's discussion topic, as well as how closely Mazarians are working together as a team across the state. Let's move to the agenda quickly. There are 6 major sections that we want to cover today. I know a lot of information. I know all the panelists are more than experts in the area and love to talk about state taxes all day long. But let's focus on the agendas and objectives for today and let the discussion be less academic but more clear and direct for our audience group. Later, if we have some time left, we'll open for questions from the audience. Okay, before we get started, let's do the first polling question first. It's an easy one. What is the weather today in your city? A, plenty of sunshine, partly cloudy, rainy and humid, snowing. It's actually partly cloudy in LA today, so I'm going to pick B.
Hopefully it's not snowing anywhere.
I was going to say. Hope the sun comes out later. Okay, let's give another 10 seconds. Okay. Wow, mostly sunny or cloudy today. Seems like. Okay, let's get started. Harry, I'm going to throw the first section to you. I know we want to cover some updates related to Public Law 86-272, but maybe before you talk about the updates, maybe give us a quick refresher overview of the background. Like, what is Public Law 86-272?
Sure, Yvonne. Thanks. It's great to be here. Public Law 86-272 is a federal law that was enacted all the way back in 1959, and it prohibits a state from imposing a net income tax on the income of a business derived from within a state through interstate commerce if its only business activities within the state consist of the solicitation of orders for sales of tangible personal property. And it only applies to tangible personal property, does not apply to services. Also, the protection only applies to orders that are sent outside the state for acceptance or rejection, and the accepted orders must be filled by shipment or delivery from outside the state. I think, as we all know, since the enactment of 86-272, businesses have been evolving from primarily engaging in the sale of tangible personal property via in-person activity to really engaging in significant amounts of electronic commerce through remote means. But Congress has not updated 86-272 to reflect its application to more modern business activities. So not long after the U.S. Supreme Court decided the Wayfair sales tax case in 2018, the Multi-State Tax Commission, or the MTC, decided that the emphasis on taxpayer protection under Public Law 86-272, coupled with the growing popularity of more technology-dependent business models, required revisions to its historic statement of information regarding the application of 86-272. And after multiple hearings, the MTC statement was adopted and released in August of 2021, and it included a new subsection addressing what constitutes protected versus unprotected activities and the treatment of certain internet transactions. And the MTC statement establishes the general rule that when a business interacts with a customer via the company's website or app, it is engaged in business activity within that customer state, meaning that those activities extend beyond the mere solicitation of orders for the sale of tangible personal property, thereby exceeding Public Law 86-272. Alternatively, if the website merely presents static text or photos, there is no engagement or facilitation within the customer state. And the MTC statement provided a list of 11 different activities conducted by internet businesses, and it provides a conclusion as to whether those activities are protected or unprotected under 86-272.
So after the MTC issued this, new revised interpretation of Public Law 86-272, how are states, reacting to this?
Yeah, well, that's an interesting question. California, that always likes to be kind of at the forefront of these state local tax new policies. In February of 2022, the California Franchise Tax Board, they released administrative guidance in the form of a technical advice memorandum, or a TAM, to explain its positions on the application of 86-272 protection in the modern economy for companies with internet transactions. And the FTB's TAM, it didn't explicitly adopt the revised statement of information issued by the MTC in August of 2021. However, it is generally consistent with the position set forth in the MTC's statement. And the California TAM describes certain internet-based activities, such as placing cookies on customer computers, providing post-sales assistance through email or chat functions, accepting applications for employment online, even accepting applications for their company credit cards online, among others, as activities that exceed the protections of Public Law 86272. And this list of unprotected activities in the TAM, generally represents the functionality and services associated with most modern websites and is widely applicable to taxpayers selling tangible products online. I would like to, I guess, just point out, income tax nexus, additional nexus, it may not always be a bad thing. California, there's about 22 states, I believe, that have what they call a throwback rule, that if you're not subject to tax in another state and you're shipping property and accepting orders in a home state, then they require you to throw back into your sales factor those sales that you're selling to other states. So in the case where you may now have nexus as a result of this new pronouncement, in California, for example, in another state that maybe imposes a throwback rule, if it's another state where you could shift income from a high tax jurisdiction to a lower tax jurisdiction. So it's not always a bad thing. You really need to look at, the overall picture and the overall footprint.
Mm-hmm. That makes sense. You just mentioned California, but are we also anticipating, more and more states gonna adopt this new policy?
Yeah, I mean, definitely. In addition to California, New York has come out with proposed regulations that would adopt the similar guidance as the MTCs on 86272. Also, revenue officials in the state of New Jersey and Oregon have also indicated that they're intending to issue formal regulations adopting the MTC's rules. So it's likely that more states are going to adopt this interpretation in the future. And I think there's also, a potential risk there too, that under audit, states may try to assert this new guidance as well.
I see.
Yeah, I mean, one other thing I'd like to point out is, and I think you can expect this as well, challenges to these new provisions or these new policies. So in August of 2022, there was a lawsuit. It was the first lawsuit that challenged California's interpretation of 86272. It was filed by the American Catalog Mailers Association. And this suit was filed in the Superior Court of California. And it essentially seeks to declare California's TAM invalid. And it asserts that the guidance is void under the Supremacy Clause of the U.S. Constitution. And the Supremacy Clause essentially establishes that the federal Constitution and federal law generally take precedence over state laws and even state constitutions. And it's, it's a significant departure from prior interpretations of the protections afforded under federal law and consistent with 86272. Additionally, the suit asserts that the development and release of this new guidance that came out from California didn't comply with California's Administrative Procedures Act, such as providing notice and public comment, which they would normally do if they were to put out regulations. So this is representing the first challenge, but it's unlikely to be the last. And then just kind of as an update, after this case was filed, the California Franchise Tax Board filed a motion to dismiss the case. But in November of 2022, the Superior Court ruled that denied the board's motion and essentially allowed the case to go forward. Again, in January of 2023, just a few months ago, the board sought immediate review of that ruling by the Court of Appeal, and they sought a stay of the trial court proceedings in a ruling that the ACMA's lawsuit could not proceed. But the Court of Appeals actually rejected that argument, denied the board's petition and request for a stay. So this case is going to go forward. There's likely, to be more. So just have to stay tuned, to see what.
Yeah. Yeah, there seems to be a lot more that we're going to see in the coming months or coming year.
Yeah, absolutely. And I think, this is just, a couple of states. It's likely, again, to see more states. And, it's really essential for companies to monitor their activities, discuss with our SALT group or other tax professionals at Mazars, really to understand, what your state footprint is and what the impacts are. Again, because it could be, beneficial. It could not be. You really need to look at the whole picture.
Yeah, makes sense. Thank you, Harry. This is a great summary. Obviously, as we hear more and more about, states' reaction to this, we'll definitely continue to provide updates in the area. I'm going to move on to the next topic because we have limited time here. The second topic we want to cover is about remote workers. As we all know, and have been hearing about this term over and over again since the pandemic, almost all companies nowadays have people working remotely somewhere. Companies sometimes might only think of this, for business reasons, but remote workers could potentially give a rise to income and sales tax exposures that might get overlooked by companies. Henry, would you please, give us maybe an overview on the tax issues around remote workers? I keep thinking about you.
Sure. I think as we all know, the COVID-19 pandemic significantly changed how businesses manage their workforces. At the height of the pandemic, millions of employees were working remotely. And now even several years in, we're still seeing companies hiring remote employees as geography is really no longer an impediment to hiring and finding the best talent, for companies that are looking to really ramp up their workforces. But the issue is having a remote workforce now can significantly impact a company's state tax nexus footprint. A company is generally considered to be doing business and subject to a state's tax laws if the company has employees working in the state, physical presence essentially. Therefore, businesses with employees working remotely could find that they're subject to state's laws just based merely on the presence of having that employee or employees. Establishing nexus to the remote workforce can create new income and franchise tax as well as sales and use tax obligations. If you didn't have nexus previously in the employee's resident state, an employee living in a different state normally may not create nexus for the employer, but as a remote worker, that employee attributes presence now to the employer through their performance of the employment duties at their home. Historically, maybe someone worked in a state and then commuted to another state into the office, but now, we're in this remote environment. Also some businesses may have had nexus in the state, but were otherwise not subject previously to income tax liability because of Public Law 86272, as I was just discussing a few minutes ago. But the federal safe harbor prohibiting a state from imposing an income tax on the seller's business activity, it may no longer apply if they're doing something that's causing that protection to be lost.
So here, there seems to be a lot of moving pieces, right? For companies, they need, when they hire remote workers, right, they need to consider from a tax perspective. What would you recommend? What would be the best practice for companies to do in terms of dealing with remote workers? Should they be like some sort of planning before they hire?
Yeah, absolutely. Establishing a nexus for any state, it really could complicate your registration, your compliance obligations. So as businesses, anytime they're looking to expand their workforce in a new state, they really should speak to their tax professionals at Mazars, SALT Group, other tax professionals, and really understand what this new change is going to do to their state tax footprint. Again, whether it's going to cause additional filings, additional tax, potentially there's some planning that can be done around that. We have conversations quite frequently with our clients when they're looking to do that. We've been doing that definitely as of late.
And aside from income tax and sales tax, there's also like withholding tax that they need to consider, right?
Yes, yeah, absolutely. There's businesses are now going to have to determine where, and when they need to withhold state and local income taxes now, by having new employees in the state. And I know Harold's going to talk about some of these issues later, but, having an individual in a state, it's going to be governed by the employee. Generally, it's governed by the employee's state of residence or state of employment, but there's exceptions to rules. Mm-hmm. And, some states may subject a non-resident employee of an in-state employer to tax on 100% of their wages if they meet certain requirements. Mm-hmm. So it's really challenging. We're in this kind of new world, so to speak. So it's really worth it to speak to tax advisors at Mazars and understand.
Us, yes.
Absolutely.
Thank you, Harry. I think this is very helpful, and I would emphasize that. Talk to us, if any of your companies are dealing with tax issues around remote workers or hybrid workers, call us, talk to us, maybe quick 15, 20 minutes. We're definitely here to assist with those types of estate planning and filing. Let's continue on. Before we continue, we have our second polling question. This should be an easy one. Is state and local tax the most interesting area among all? Yes is A, and then B is let me think about it.
And this is Harold. While you're contemplating your response, Harry, great presentation. And I think the key takeaway for me is that companies really need to reassess their state and local tax posture, even if you've done a nexus study in the past with these new developments vis-a-vis 86272 and remote workforce. It really pays to revisit nexus to make sure that your company is filing in all jurisdictions that it should be.
Thank you, Harold. Okay, we have a good split. Okay, let's move on. The next topic is a hot topic nowadays because more and more service providers are facing challenges when they need to apportion their income into various states. And I know the rules for each state are not only complex, but also vary quite much. Julie, I'm gonna, direct this section to you. Would you please give us an overview on this?
Of course. So I'm going to talk briefly about some trends in apportionment, mainly the sales factor, which have been trending for a while, but thought it was worth a quick overview and to touch on some recent changes. Let's talk about market sourcing. Historically, there's always been a split among states in how to determine the sales factor. The methodology was either cost of performance or market sourcing. For those of you who don't know these terms, market sourcing methodology sources the revenue to where the customer is located or where the benefit of the services is received. Cost of performance methodology basically sources sales to where the taxpayer incurs the expenses associated with providing the services, which is usually where the cost of labor is or the office location, since those are normally the biggest expenses associated with providing a service. So over the years, as many of you have seen, more and more states have moved away from cost of performance and have adopted market-based sourcing. There are, as of now, about 35 states that require the use of market-based sourcing, and that number is only increasing. So what's the impact of this trend? In the days where states really varied in cost of performance versus market sourcing, it was very common for taxpayers to be double taxed due to including certain receipts in the numerator in more than one state. I'll give you a simple example. If you're including 100% of your receipts in state A, which is a cost of performance state, because all of your employees and your office are located in state A, and then you have to include 20% from those same receipts in your sales numerator for state B, which is a market state, since 20% of your services are provided to customers in state B, then if you think about it, that 20% of your revenue is double counted. It's included in both state A and state B. So, that's just a very simple example using two states. We've had many clients come to us and ask how this possibly can be correct and express frustration with this double taxation. The good news with this trend toward market sourcing is that without such a widespread mixed use of cost of performance-based receipts and market-based sourcing, the risk of this type of double taxation is somewhat mitigated. So this trend could be beneficial for many taxpayers. Now, market sourcing can be challenging for a number of reasons, especially when it comes to business customers. One issue that has been kicked around quite a bit is the look-through notion of market sourcing relevant to certain B2B services, really when we're looking at intermediary transactions. California, for instance, has gone through numerous discussions around who the customer is in these scenarios. Is it the taxpayer's customer or the customer's customer who should be considered as actually receiving the benefit of the taxpayer's services? After two prior rulings where the California Franchise Tax Board decided not to adopt look-through sourcing, their most recent ruling provides that it is the customer's customer who ultimately receives the benefit. Theoretically, while this methodology may make sense, practically speaking, it creates some challenges for taxpayers to be able to come up with this information. California, similar to some other states like Connecticut that have adopted the look-through concept, do provide guidance using cascading rules to help approximate this amount when it's not readily available. But these rules can also be somewhat cumbersome. As much as they are helpful, they're not as easily followed in theory. So these intermediary transactions are going to be challenging from a sourcing perspective in states that adopt the look-through concept. So you can see how the application of market sourcing may not be as simple as it seems. Taxpayers have to make sure they have adequate record keeping to determine the location of where the benefits of their services are actually received. Another situation where it is not always going to be obvious is when you have customers who are multinational or multi-state companies. In many cases, customer records will include the customer billing address, and this is what is often used in most cases as an indication of where the benefit was received. But often, the services provided by a taxpayer will provide benefit to various locations of a multi-state or multinational customer, not only to the office where the invoice is sent, which is the billing address. So if you think about it in this scenario, it's possible a taxpayer can be sourcing significant amount of revenue to a high tax state if you use the billing address instead of the actual locations of the benefit received. So this is another reason why it's important for taxpayers to be thoughtful when it comes to their record keeping.
So Julie, thank you so much. You talked a lot, about the two, sourcing method, right? The cost of performance rule and market-based sourcing method, and the trends of moving towards the latter. And also there's a lot of, complicated, things that taxpayers need to factor in, also record keepings and everything. But when, taxpayer, get all the data, when they actually compute their state apportionment factors, do you see trends that, because I know it has been 3 factors for a lot of states, do you see trends that, more and more states are moving from 3 factors to single sales factor to kind of simplify the calculation, the apportionment.
Absolutely, absolutely. So, you know, I have talked about the ongoing trend toward market-based sourcing, but, you know, the other trend I wanted to mention that often comes hand in hand with the states that adopt market-based sourcing is moving away from the 3-factor apportionment formula, like you said, Yvonne, toward a single sales factor. Because really, if you think about it, that would make sense that both changes are made since we are indirectly de-emphasizing the property and payroll factor when we move from cost of performance to market-based sourcing and focusing more on where your market is. So what we're seeing now is an ongoing trend of states adopting market-based sourcing along with a single sales factor or a more heavily weighted sales factor. So this can be seen as a transition to more accurately reflect the taxpayers' business activities amongst the states. But these trends are also legislative changes that are mechanisms used by many states to shift the income tax burden away from in-state businesses to out-of-state businesses, obviously to promote economic growth and investments within those states. So there is a big element of tax policy involved in these trends as well.
Mm-hmm. That makes sense. You know, also, I see it more from maybe a compliance perspective too. Apparently, it would be a lot easier, you know, if more and more states are doing single sales factor calculation, because it, you know, takes less time to do the calculation and report on the return. So thank you, Julie. We talked a lot, you know, from income tax perspective, and I understand for sales and use tax, this concept can get quite complex as well. Kevin, I'm going to ping you really quick. I know you're the sales and use tax expert. Would you mind chiming in and maybe give us some insight on the sales tax side?
Yeah, Yvonne, so sourcing sales toward the benefit received is also a hot topic for sales and use tax compliance. Where to source sales and purchases of service, specifically software as a service, can be complicated for sales tax compliance, especially given the increase in remote work. Clients need to be mindful of where the benefits actually received and is going to ensure that the sales tax is collected in the appropriate state or that they accrue use tax when necessary. Utilizing the billing address, as Julie noted, may not lead to the right result, and clients need to be aware of this and the rules in the markets that they operate in, because it can create a situation where the sales tax is charged improperly or that the tax does not get paid or is paid to the wrong state, which can lead to costly mistakes.
Thank you, Kevin. This is great. I think the audience might have some questions already on this. Let's park all the questions to the end. I really want to, go through all the updates that we want to discuss today. Let's move on. The next section or the next topic that we want to cover is for pass-through entity tax. As the audience might have already heard a lot about this new but not so new pass-through entity tax, PTET. If the pass-through entity only files in one state, I think seems a lot easier to compute. But if there are states involved, there are possibilities that not 100% of the PTET benefits will be received by the taxpayer. Harold, I'm going to ping you in. Would you please, talk a little bit about, the state apportionment impact on this?
Sure, Yvonne. Thank you. And I think we would be remiss if we didn't at least give a quick overview as to the genesis of these pass-through entity taxes, which really came about as a result of a pretty unpopular provision in the Tax Cuts and Jobs Act of 2017 that limited the state and local tax deduction to $10,000 on personal income tax return itemized deductions. So right away, the state started trying to think outside of the box as to how they might be able to help taxpayers with respect to that limitation. And that really was the genesis of these pass-through entity taxes, where the entity pays the tax rather than the individual. So partnerships and S-corps pay taxes to the state at the entity level rather than the individual paying the tax at their level, and the individuals receive a credit for the taxes that are paid by the pass-through entity. So that was the way around it. So effectively, when it comes to the pass-through entity benefits, there's a lot to consider with respect to whether it makes sense to elect pass-through entity tax status or not. The apportionment to the state is one of them, and as Julie mentioned, particularly for service companies, there's a lot of complexity surrounding apportionment. Clearly, if a pass-through entity is only engaged in business in one state and has 100% of its income derived from that state and reported to that state, it's a pretty simple calculation. However, many states have rules that for a multi-state company, if a resident shareholder or resident partner is participating in the pass-through entity tax, then 100% of their distributive share of income would be subject to that pass-through entity tax, whereas a non-resident might only receive benefit to the extent that the company has income sourced to that state. And I think there's a scenario here where it's a one-size-fits-all, doesn't necessarily apply. So that what's good for the residents might not be as beneficial for the non-residents of a particular state. Again, on the surface, pass-through entity tax elections make a lot of sense, but a deep dive and analysis really needs to take place.
Yeah, thank you, Harold. I know we kind of like jump ahead and then, talk about, the benefits and all of that on PTET, before, but like you mentioned before, pass-through entities can, take the PTET deduction. They need to make an election for it, right? And I think we should touch a little bit about the election because it can get complicated when there are tiered ownership involved in a pass-through entity. Julie, do you want to chime in maybe quickly on this, like talk a little bit about ownership of pass-through entities and who can make the PTET election?
Sure. So as Harold mentioned, the way the PTE tax works is it allows partnerships and S-corps to make an election to pay income tax at the entity level. The benefit of this is, as you said, it's that the individual owners of the PTE can indirectly take a deduction for the state taxes paid by the entity on their individual returns, effectively allowing them to avoid the $10,000 SALT cap. But just like everything else related to state tax, the election itself and reporting can be complex, mainly because PTE may or may not qualify for the PTE tax in certain states if it has a corporate or PTE partner. So the ownership group of the PTE is going to have an impact on eligibility to make a PTE election in some states, as well as what the reporting requirements are going to be in the various states. So S-corps and partnerships with only individual partners won't have these issues. They won't have the reporting issues because it's rather simple. But if a PTE has other PTE partners, they do qualify to make the election, then the reporting requirements can be quite burdensome. In some cases they won't qualify, but in the cases that they do, they're going to be subject to some reporting requirements that are complex. So in cases of multi-tier partnerships, any PTET deduction or credit has to be flowed through to the ultimate individual owner, which is often unknown. But without the proper reporting, we're going to see instances where the ultimate owner may not be allowed to take the PTE credit on his or her return. So when we're making a determination of whether to make the election, you got to keep in mind who the owners of the PTE are. I know Harold has worked a time with many of our partnership and S-Corp clients on the PT election. So I'll pass it on to him.
Thanks, Julie. Great synopsis. So in a nutshell, I think what we have is when it comes to making the election, again, an analysis really should take place with respect to the benefits, the detriments. Certainly, some clients, in particular, ones that don't really have recurring income, so private equity or investment type entities, might have more difficulty when it comes to ascertaining what their income will be. As an example, New York State requires the election to be made by March 15th of the current year. So it's hard to tell, gee, are you going to have any material amount of income or not? And I could say to you that certainly we've heard that there were some taxpayers that have regretted making the election because in the end, they really didn't have as much income as they expected. The benefit really wasn't that great, and the administrative burdens were perhaps more than what they expected when it comes to making the elections, filing separate returns, and so forth. So a lot goes into whether it makes sense logically to make the election or not. And Yvonne, back to you.
Thanks, Harold. I know with the limited time, we're not able to touch all the issues around PTET election. But if, audience, if you have any questions about this, please feel free to put in the chat. We'll get to it later after we finish all the sections. I want to talk a little bit more about S-Corp here because as we all know, S-Corp is a unique existence among the other pass-through entities since it requires income and deductions as well as distributions to be made pro rata based on ownership percentage. From a federal perspective, if things are not being allocated proportionally, there is a chance that IS can come in and revoke the X status. And that essentially will put the entity back to C Corp, which you get double taxation, right? So this creates potential issue and risk for S Corp taxpayers when they think about making this PTET election. It is very important for companies to really understand how this works and the particular state rules around PTET. For example, like for California, it could potentially violate the S election if the companies change their distributions to fix the economics caused by some of their shareholders not consenting to include and or consenting shareholders are composed of California resident and non-resident. So in this situation, definitely come talk to us before make any changes to the allocation because that could potentially jeopardize the S-Corp status. That's what I want to kind of add on a little bit from a federal perspective. Before we move on to the next section, I think we have a third polling question here. I hope we get 100% on A. Are you still here? A is yes, B is kinda, C is no. Let's give like 20 to 30 seconds here.
And while you're contemplating your answer, with respect to the allocation and apportionment for service providers, whether it's from an income tax or a sales tax perspective, I think the key takeaway is it's a lot more complicated than it might seem on the surface. And taxpayers really are required by the states to exercise some diligence with respect to trying to identify where the customer is located or where the benefit of the service is received. So it's really important from a record-keeping perspective and a diligence point of view to not just take the easy answer and say it's based on the mailing address of the customer.
Thank you, Harold. And yes, we get 100% on yes. Okay, let's move to the next section, sales tax. As everyone knows, the economic nexus rule applies not only to income tax, but also sales tax. And a lot of times they're different. Kevin, I'm going to pull you in because you're an expert here. Would you please give us an overview on the economic nexus issues on sales tax, especially, the famous Wayfair case and how it has been impacting our clients since then?
Yeah, so the 2018 landmark Supreme Court case, Wayfair v. South Dakota, has changed the way businesses handle sales tax compliance. Before Wayfair, businesses had to collect and remit sales tax in states where they had a physical presence. But with the rise of e-commerce, the court recognized the standard was outdated and unfair to traditional brick-and-mortar stores. The Wayfair decision allowed states to require out-of-state businesses to collect and remit sales tax if they meet certain economic thresholds. And it didn't take long for states to enact similar thresholds in their states. As of January 1, 2023, just 5 short years later, all states that impose sales tax have adopted similar economic nexus standards.
Kevin, so you just said the nexus rules, based on the dates that you've given, so the nexus rules for sales tax seems like have changed drastically, right, in such short period of time. What does that mean for our clients?
Yeah, Yvonne, so states were quick to adopt these rules, and unfortunately for taxpayers, there isn't exact uniformity across all states. For our clients, they need to monitor in what states they're selling in and the state's rules and regulations regardless of if they have a physical presence there. While most states impose similar economic nexus thresholds of $100,000 of sales or in some cases 200 transactions, what transactions are included in that threshold and the calculation period varies widely among the states. This ruling has really impacted remote sellers of tangible personal property, wholesalers, and software providers. The rapid response by states to implement similar laws in their states required businesses to act quickly and implement new sales tax procedures, policies, and software solutions to make sure that they're collecting and remitting the correct amount of sales tax in each state. Businesses now must consider the tax implications when expanding into new markets, which means carefully evaluating the costs and benefits of complying with each state's sales tax laws. Wholesalers were particularly impacted by this decision. Prior to Wayfair, as long as a wholesale business didn't have a physical presence in a state, a missed exemption or resale certificate didn't necessarily create exposure for that business. In a post-Wayfair world, a wholesale business missing an exemption or a resale certificate for a customer of theirs could create exposure under audit because they don't have the substantial documentation to substantiate it being exempt. Overall, the Wayfair decision has brought some much-needed clarity and uniformity to the sales tax landscape by giving bright-line rules for taxpayers to follow. While it may seem daunting at first, the SALT team here at Mazars can help businesses implement new procedures, policies, and software to ensure that they remain compliant and thrive in this ever-changing sales tax landscape.
Thank you, Kevin. So you mentioned, we implemented new procedures and softwares to help clients in that matter. So can you elaborate a little bit more on that? So what are some of the action steps that we Mazars have taken in the wake of Wayfair?
Yeah, Mazars has responded to these changes by increasing the frequency of sales tax nexus and taxability studies and reviews, sales tax process and procedure reviews, and tracking economic nexus for our clients. We've also helped clients with quantifying any prior exposure and then assist them to come into compliance in states where they have obligations to pay sales tax. That could mean registering and filing past due returns or assisting clients with voluntary disclosure agreements. And for anyone that's not familiar, voluntary disclosure agreements is a great tool for helping clients come into compliance. In many cases, it reduces the look back or the exposure period and eliminates penalties. Mazars is also assisting clients with outsourcing their sales tax function and helping them choose and configure sales tax softwares to improve their tax processes. This really allows our clients to free up its internal resources and boost productivity and let its employees focus on growing their business and not getting bogged down with the rapidly changing and complicated sales tax compliance. So with that, I'm going to kick it over to Harold, who's going to discuss the Mazars sales tax compliance solution a little further. Harold, so what does sales tax outsourcing look like in practice here at Mazars?
So in a nutshell, many of our clients, once they've gone through the process of a nexus study and taken into account not only Wayfair, but the changes in their businesses, where many companies that previously were only wholesalers and now also selling direct to consumer. Kevin and his team have developed our sales tax compliance solution, which features automation along with world-class software to process the sales tax returns in a very efficient manner. And ostensibly, what it's done is within a 10-day period, the taxpayer's information is uploaded by us, converted into a data format that our sales tax compliance software requires. The processing and review of the returns. The returns are sent to the client if the client chooses to review them. And effectively, between day 10 and 15 of each month, the returns are locked. The returns are submitted electronically. Payments are also typically submitted electronically. And it's a very seamless process. It is a complete, from beginning to end, process that our clients have really enjoyed. And as Kevin mentioned, the ability to offload that responsibility to us has really been, I think, a time saver, and it's been deeply appreciated. So looking forward to working with many of the folks on this webinar as well if their needs require.
Thank you, Harold. Yeah, I think this chart is super helpful. Like, I think for the audience group, definitely reach out to us if, this is something that your company is looking for from a sales tax compliance solution perspective. We're definitely here to help. We have one last section to cover, and then we can have some time for questions. Before we get to the last section, I have one last polling question here. Are state and local tax review becoming more common now? Yes, with every state. Yeah, that's going to be my answer. B, I got it all. C, I don't know. So let's give another 30 seconds here. Okay. Yeah, I think we're in agreement for this one. It's like every state now, there's issues here and there with every state. It becomes more and more common. Okay, last section. Harold, since I have you from the sales tax part, I'm gonna leave the best section to you. The last section. It is a short section. I know we want to talk a little bit about personal income tax, in particular related to the convenience of the employer tax. So, Harold, what is this tax? Can you give us more background on this?
Yes, Yvonne. As Harry mentioned in his presentation on remote work, there was complexity surrounding the sourcing of salary and wages for remote workers. Several states have what are called convenience of employer rules. It's an odd name for it, but effectively what it means is that if an individual is working from home and it's for their own convenience versus out of necessity, then the states that employ that convenience of employer rule require that the salary and wages earned while working from home be sourced to the office location and not to the home location. So as an example, if an individual is assigned to a New York office of their employer and they perform at least some of their services in New York and they work in a hybrid situation where they spend some of their time working remotely, effectively for their own convenience, New York takes a position that that is New York source income to a non-resident. Clearly, this is an issue both for the employee and the employer, as employers are required to withhold where appropriate. And there are a number of other states that are assessing these particular rules because obviously there's a detriment to a state, as an example, New Jersey, that is really agitated by New York's aggressive enforcement of this rule because basically New Jersey feels that their revenues are being negatively impacted by New York because they have to give a resident credit to the individual for the income that is being taxed by New York. So as this continues to develop, we are pretty confident that additional states may start to look into enacting these types of statutes as well. And Yvonne, back to you for any of the Q&A.
Thank you, Harold. I think perfect timing. We only have a few minutes left, and maybe just for one question from the audience. And I know there's multiple questions in the chat, and we'll make sure we get to all of them after the webinar if we don't have enough time to go through all of them right now. I will pick the first one. If my company has sales tax methods in the United States, does that mean we need to file income tax returns as well?
Yeah, I think the answer to that is no, not necessarily. That the sales tax nexus rules have an extremely low threshold with respect to economic nexus, whereas for income tax, as Harry indicated, Public Law 86272 is still the law of the land. And even though the states are trying every which way to dilute the effectiveness of 86272, it's not necessarily the case that if a company has sales tax nexus, they have income tax nexus as well.
Okay, cool. I know we are about to close. We have a minute and 20 seconds here. I would love to add maybe one last comment to our audience today. I think it doesn't really matter what size your company is or how small or complex of state issues that you have. If you're currently using other firms or Big Four to handle your state tax work, please give us, Mazars, just a quick 30 minutes out of your day and have a quick discussion with our state tax experts. I think just to hear from us like what we can do with a fresh pair of eyes will be definitely helpful for the companies. My background is in corporate tax and I work a lot with our state tax team. And I know it is more than just the four amazing speakers that you're hearing on the panel today. We also have, a whole team behind the scenes supporting with the day-to-day work and communications. Before I turn it back to Olivia, thank you all, the panelists again. Thank you so much. And thank you everyone for joining us today. Have a wonderful day.